This is Joe Anderson, president here at Pure Financial Advisors. The main speaker is Brian Perry, so I'm going to give him the stage and the camera. But I'm here to help out. We want to get your questions in regards to your thoughts, your concerns about what we're doing here at Pure, your portfolio, and the markets in general. It's been kind of an interesting past couple of weeks, as we all know. And so we thought we would try to do a live streaming after the market closed here today on Tuesday, just to give you a little bit better insight on what to expect in the overall markets, what we're doing here. Brian Perry, he's a CFA, certified financial planner. He basically runs our investment team and department, director of research, has 20 years experience. Most of you met Brian in the past, but I want to turn the floor over to him to have him give you the insights that I think we're all anxious to kind of dive into.
Thanks a lot, Joe. Welcome to everybody remotely. In this day and age, it's as close as we come to anybody, but we continue to fully function, and all our trading capabilities, all our financial planning capabilities, our advice delivery all remains intact. We're just doing it all remotely to keep everybody safe. You talked about the interesting times, and I'm always reminded at times like this of that old Chinese proverb, and there's debate about whether it's a blessing or a curse, but the old saw about may you live in interesting times. And certainly this is interesting times, unprecedented times in some regards, where over the last 15 or 20 years, we've seen SARS and the bird flu and stuff like that. And, I'll be fully candid in saying that I kind of expected this to be something similar, and it's certainly morphed into more than what those episodes were. And so, I was on air a couple weeks ago saying that I didn't think that this would be quite as big of a deal as it is. And to a degree, I'm going to keep this as an economist and a finance person. I'm not a doctor. I don't claim to know the medical spread and stuff like that. But to a lot of degrees, what's hurting the markets and what's hurting the economy is not the disease itself, and not to minimize the impact of that, but it's the financial impact, right? It's people's responses to this, and the fact that essentially Americans' way of life, as we know it, has been to a degree shut down. No March Madness, no NBA, no sports, no Broadway theaters. AMC movie theaters have closed now. Disneyland has closed. Social distancing is a thing now, where Joe and I, as we record this, are keeping a respectful distance from each other. So the very way of life that people have become used to has been impacted significantly. And in that kind of environment, it comes down to investors, human beings, we're all just biologically designed to flee or fight. And this is a situation in a lot of regards that reminds me of September 11th. In the sense that the September 11th attacks were very tragic, but it was the economic response afterwards, the changing of behavior of not traveling and stuff like that, that really helped tip the economy into a recession. But there was a common enemy, somebody to unite against, with the Taliban and Al-Qaeda and the like, to get angry at, and the fight response. And here, there's nothing to fight. It's a virus. There's nobody to be angry at. And so I think that people in general are fleeing. They're shutting down, and they're selling securities and trying to get out. And this time is different. Every bear market is different. And for those of you that have seen me speak in the past at our lunch and learns and things like that, I, for a while now, been talking about the fact that bear markets are part of the cycle. Recessions are part of the cycle. We have these on an ongoing basis. In fact, if you look at it on average, financial markets fall once every 12 months by an average of about 14%. It's a very common thing. And yet in most years, markets actually go higher. And so in a lot of cases, it's a year in which markets at some point fall and demonstrate negative returns and then end the year positive. There are times, though, that we have a bear market. The statistics are such that over the last century or so, we've had about 90 corrections, and a correction in the financial markets is usually defined as a decline of 10% or more from the high. Bear markets, on the other hand, are defined as a drop of 20% or more. And at the lows, we've been down about high 20s, close to 30% on some of the major indexes. So this is a bear market. And in fact, 35% is an average bear market, depending on how you want to measure it. Most of the time in a bear market, stocks fall by about that amount. The last two bear markets that we had prior to this, which were 2008, 2009, and before that 2001, 2002, were two of the more severe bear markets post-World War II, in which we were down about 50% in each of those cases. Not to say that we couldn't go down 50% in this environment, but that would be historically an exceptionally bad bear market. Where we are right now is closer to a typical bear. And here at Pure, we're believers that the future is impossible to predict, or at the very least, very difficult to predict. And so we don't try to do that. But we do rely on the empirical research and the data, which says that if you follow history, we're closer to the bottom than the top, or the beginning rather. We're closer to the end of this decline, and don't know exactly when it will end, but we do know that it will. And I think it's important to remember that although we're in a bear market right now, and although we could very well tip into recession as a result of what's going on, the sun will come out. Every bear market in history has ended. One of the questions that came across, and please, as you go along, feel free to ask questions, type them into your browser, and we'll get to as many of them as possible.
Hey, let's pause there real quick, Brian. And how do people actually ask a question?
Yeah, so I believe that there's a Q&A bar at the bottom that they can click on and then type in the question, and it'll enter the queue.
Perfect. And then when those questions come up, I'll ask them. I need a job to do.
Perfect. No, that's very important.
All right.
That's very important. Yeah, and so, on average, bear markets have happened. This, to me, is not as bad as 2008, 2009 from a financial perspective. At that point, I'd been in the financial markets about a dozen years at that point, and I saw the financial system starting to collapse. I saw financial markets and bond markets and money markets seizing up, and had very real fear that banks weren't going to open. I think that central bankers, the Federal Reserve and the like, have learned a lot since then. And, I've been encouraged by the support that they've been giving financial markets. Some of the more arcane aspects of finance are what really matter at times like these, things like money markets and commercial paper markets, which got renewed support from the Federal Reserve this week, the mortgage-backed security market, which the Fed came out and supported over the weekend and the like. And now we're seeing the federal government come in with fiscal stimulus too, or talk of a large fiscal stimulus package. And Joe, you and I were just talking yesterday, I think it was, about what might cause the selling to come to an end. And to me, it's two things really. It's a cessation or a slowdown of bad news, right? Markets go up and down, not so much on good or bad, but on better or worse. And if we can at least get a slowdown of the bad news and of the way of life that we know shutting down, I think that then that opens up space for good news to come in. And good news, the biggest source of that would be a fiscal response. And that's what we heard talk of today. And what had happened, the Dow rallied about 1,000 points. And so, hopefully that's the start of something good. Don't know that for sure, but we do know that this will come to an end. And what I want to do now is just talk a little bit about what we've done in advance for this and how you prepare for a bear market. And generally, it's not something that you react to, it's something that you prepare for. And that's what we've done for all of you out there with your initial portfolio allocation, right? As you went through your cash flow planning and your financial planning, determining what appropriate portfolio made sense for you, and then owning a mix of both stocks and bonds, right? And those bonds, those high quality assets, have done exactly what they're supposed to do in this environment, where we've seen bond yields come down quite a bit. We're down more than half, from 2.5% a couple years ago to we dropped as low as 0.5% on 10-year treasuries. And so those bonds have been providing ballast in portfolios and are what are there to be sold either for rebalancing purposes to buy stocks when they're on sale, or to generate income for those of you that are living off of it. And so it's been good to see bonds acting the way that we would hope that they would in this environment. So that's something that you do ahead of time, right? Not react, but prepare. And, and then it's about staying the course and sticking with that long-term allocation. And as a financial advisor, I sometimes feel like a broken record giving that advice. And I sometimes know that a lot of people hear it and that it can sound repetitive or trite, but it's so true that the worst thing that people can do during difficult markets is sell, because every bear market in history has seen a recovery. The longest recovery in history was following the Great Depression, where stocks made a low in 1929 and then didn't make a new high until 1954. But even in that worst case scenario where we had World War II in the interim, even where we had bread lines and the like, we still recovered and eventually made new highs. And so, I don't see any reason why this would be different. Let's pause, and I just want to show a couple slides here around some of what's going on in the financial markets. And so for starters, what we want to look at here is just the level of fear that we've seen in financial markets. And this is the VIX. So this is a measure of volatility in the financial markets. And what's most interesting to me here is that this goes back from 1990 or so. And you can see that recently it spiked up near 82. The numbers themselves aren't so much important, but what really is interesting is that if you look at 2009, the level of fear, the level of volatility being measured in the financial markets wasn't as high as it was last week. And that to me speaks to just how frightened people are by what's going on and that sense of panic that we've seen in financial markets, which again seems to be slowing down and dissipating, is the fact that markets were reacting more severely than they even did during the financial crisis. And the reason why is simply the fear that the economy will slide into a recession. And to be honest, I don't have a crystal ball, but I suspect that we will see a recession. Recessions, again, being a normal part of the economic cycle. This chart shows one of the reasons why. If you look at the right-hand side, it shows the breakdown of gross domestic product in the US, and you see the light blue there, 68.1% of the US economy is domestic consumption by the consumer. And so if the consumer is the main driver of the economy and consumers are essentially unable to go out and spend at the moment, then that would lead to a slowdown in economic activity. To me, so what's important though is not whether or not we go into a recession, it's what kind of recovery we have. Do we have a sharp V-shaped recovery, or is it more of an L shape where we drag along the bottom? Because make no mistake, there will be a lot of pent-up demand. I don't know exactly when people will be able to go out and live their lives again, whether that will be in a couple weeks or a month or two or something like that. But as the weather warms across the country and as the economy returns to normal and the virus dissipates, there's going to be a lot of pent-up demand for leisure, travel, and the like that I suspect will give us a relatively robust economic recovery when it comes about. In the meantime, we have seen a pretty sharp sell-off in stocks. When you look at the S&P over the last year, you can see that we enjoyed quite a bull market. And even as early as February, we were making new highs in the financial markets before this very sharp sell-off, and then again, a rebound here today. But recently we sent around a communication on the financial markets and talked about framing and the importance of how the story is positioned. And so while it's true that stocks are off the better part of 30% in the last couple weeks, what's also equally true is the fact that stocks have had a really good run over the last 5 years. And so if you look over the last 5 years, stocks have done quite well. And despite the recent drop-off, we're still quite a bit higher than we were even when President Trump took office. And so it's important that in the face of an onslaught of negative news, you consider the fact that just because the news is all being framed poorly doesn't mean that there's not a lot of good news in there as well. And in fact, stocks have had a very good run over the last 5 years and over the last 10 years, even taking into account the recent price action. Looking at some different parts of the portfolio, one area that we could see some improvement in would be emerging markets. And emerging markets are something that hasn't done as well, with the exception of 2017, haven't done as well as US markets over the last decade or so. But when you look, there are a few things going on now that could help over there. One of them is simply the fact that oil prices have collapsed, right? So oil's gone from over $70 a barrel down to around $30 a barrel here. And a lot of the international markets, the emerging markets, particularly China and the Asian economies, are very big oil importers. And so when you look at the price of oil dropping significantly, that serves as quite a boost to some of the larger emerging market economies. Again, not so much the Latin American countries like Brazil and Mexico, but those big Asian emerging markets like China could benefit from these lower oil prices. China also, although they suffered from this coronavirus sooner, seems to be coming out. And we're hearing stories of economic activity in China, including in central China where the disease originated, picking up and beginning again. And so we could see that part of the world pick up sooner than the US, even since they went into this first. And finally, I think that the one thing I would end with here, and then we'll open it up to some questions, is that remember that just like with the virus, where it's most significantly impacting people that maybe aren't as healthy to begin with, the economic impact is the same thing, where when we look at the economic impact of the slowdown, consider the starting point. And the starting point was an economy that was doing pretty well as we came into the year, right? And consider some of the challenges that the economy faced and some of the concerns we had last year despite a strong economy. I think they've dissipated. And two that I would name that I think will play out a bigger role as the virus dissipates are, one is the trade war. Right? I haven't seen a single headline about the trade war since the coronavirus picked up. And I think that in an environment where the world is coming together to fight against this disease and is also concerned about a global economic slowdown, the idea of trade war definitely slides to the back burner. And once we come out the other side of the virus, the absence of trade war talk between the US and China could definitely provide a tailwind to the economy as well as the financial markets. And the other one, and this is not a political statement as far as supporting one candidate or the other, but financial markets have been quite afraid of Bernie Sanders being elected president. And recently, Joe Biden has taken a pretty strong lead in the primary and seems to be the front runner there to position himself against Donald Trump. The idea of Bernie Sanders dropping out of the election potentially or not winning, I think could be another something that was hanging over financial markets before coronavirus, that if that's gone, will also provide a tailwind when we come out the other side of this. So, we'll open up to Q&A, but I think the important takeaway here is that although markets have been volatile, the external environment will lighten again at some point, and diversified portfolios are going to do what they always do.
All right. We got a few questions coming in. Popular one, Brian, should I change my allocation? Is now a good time to change the allocation?
In general, no, but that assumes that your allocation was correct to begin with, which is the reason why we go through financial planning. In general, the reason that you change your allocation is not because of an election or a market decline or what's going on in the external environment. It's because of life changes. So should you change your allocation? The answer would be yes, if your life has changed in some way. Let's say that you got married, you had kids, you had grandkids, you retired, et cetera. But assuming that your allocation was set up for your circumstances and your position in life and was based upon your financial planning, no, I don't think so. You probably have some safe assets in there that are doing okay, and you have some assets that maybe haven't done as well lately, but that's why we rebalance the portfolio, is to sell what's done well and buy some of what hasn't done as well.
Piggyback on this one, but should I go to cash? I guess you just answered that.
Yeah. I mean, the answer to that would be yes, as you know, if you knew exactly when markets were going to rebound, right? But I think it's important to keep in mind that the best days in financial markets usually occur immediately after the worst days. And we've seen that just in the last week and a half, where we've had a couple of 5% rallies after some really bad days. And so the problem with going to cash is that you need to be right twice. You need to be right on going to cash and then on moving back into the markets. I didn't comment on this yet, but I think it's important to realize that the stock market is a leading indicator. And although the stock market has fallen a bunch and the economy may go into a recession, that doesn't mean that stocks will continue to fall. A lot of times the stock market falls, and then as the economy heads into a recession, the stock market picks up. And so keeping in mind that the stock market is a leading indicator would tell me that no, it's probably not the time to go into cash now while stocks are effectively on sale.
Would you think of a scenario where if someone had enough money, right? Because when someone has the appropriate amount of dollars to accomplish their goals, no one minds market volatility when the markets go up.
Yeah.
Right. But then the nervousness comes when market volatility on the other side of the equation.
Yep.
What are some strategies that you can think of maybe to calm people's nerves so they don't hurt themselves necessarily by totally getting out of the market, by going into cash? But I know there's a lot of people, they're getting to a boiling point where it's like, I cannot take this any longer. I can't necessarily sleep at night. Is there ideas or things that you can maybe ease some of the nerves in regards, maybe just don't sell out and go to cash, but is there some other strategies maybe to ease some of that?
Yeah, I mean, I think one is obviously controlling the things you can control, right? Which is knowing that, hey, if you have a taxable account, you're doing tax loss harvesting, which we're doing. So at least the volatility is not fun. It's like turbulence on a plane. Nobody signs up for it. But if it's part of the process, at least you're getting some tax advantage out of it. Getting back to that initial allocation, hopefully the initial allocation was appropriately set. But the one thing is I think that there's the ability to take risk and then there's the willingness to take risk. And a lot of times people confuse the two. And so just because somebody has the ability to take risk, if they're now extremely uncomfortable, it may mean that their willingness to take risk isn't quite as robust as they previously thought. And so I don't know, that could be an opportunity to reevaluate the financial plan and see if maybe taking a little bit of risk off the table is the right move. But again, it's always measured steps. And when I used to work managing money for institutions, it was never about going from, Joe, like you said, all to cash from stocks or something. It was going from 60% stocks to 55 or 50 or something like that, if that was appropriate. So I think in general, people that make very drastic moves wind up regretting it. People that make measured moves or measured changes, sometimes that can be appropriate. But I think what you want to do first is run it through your cash flows and your financial plan and see if that's something that still gets you where you want to go.
All right, a couple of other questions. Are global markets the same as emerging markets?
Emerging markets, that's a good question. Emerging markets are a part of global markets. And so when we talk about global markets, we're really talking about the entire world, so including the US. And usually there's three subsets. There's the United States, there's international developed markets, and I sometimes think of it as places where you don't have to boil the water. So you can think of Canada, Australia, Europe, Japan, places like that. And then emerging markets are most of Asia, most of Latin America, Africa, and the like. Some people will break it down even further into frontier markets, which tend to be smaller and less developed emerging markets. In our portfolios here, we own all of those, with the exception of the frontier markets, but we own emerging markets usually as a slice of the portfolio, because emerging markets over time have produced higher returns, but they're also more volatile. So we use them sparingly to add a little bit of juice to the portfolio, but just like spice or pepper on your food, you don't want to use too much. And then we also own international developed markets because there are a lot of great companies over there. You know, you have the Nestle's of the world and the Toyotas of the world. And then, of course, U.S. markets are the largest holding of the portfolios.
Subset question to that. How are you readjusting the balance of the portfolios in their proportion of global markets given the worldwide pandemic?
Yeah, so we're rebalancing almost every portfolio practically every day just because things are moving so rapidly. We use tolerance bands of about 20% on either side. So if a target for a position is 5% and it goes above 6 or below 4, we're buying or selling appropriately. And that's based on a lot of research. We actually just analyzed that again last year to see if we wanted to tighten those bands in with reduced trading costs, and decided that based on some statistical modeling that 20% still made sense. We haven't changed our allocation to international markets based on what's going on for two reasons. One is simply because, again, parts of the emerging world in particular went into the coronavirus epidemic sooner, so we think they're coming out sooner. So from a tactical perspective, I don't know that getting out of emerging markets or reducing there would make sense. But also just valuations. U.S. stocks, particularly for larger growth companies prior to the recent sell-off, were a little bit elevated compared to historical averages, while a lot of the international markets are relatively less expensive compared to historical averages. And so we like the idea of sticking with that allocation for the moment. But of course, we're continuing to evaluate that. And if something changes, then we'll make an appropriate change. But we don't want to be swayed from a long-term fundamental belief based on a movement that, you know, we think is temporary.
Can you comment on the solvency of DFA funds?
Yes, yeah, absolutely. No concern at all there. There's a variety of protections in place. And I would say this isn't just for DFA funds. This is for any mutual fund or exchange traded fund. They're baskets of securities. And so the mutual fund company or ETF company itself, the solvency of that, even if it were to go away, you still own the fund with all of the underlying holdings. So in order to lose money, you would need every single underlying company to go under, which I think is unrealistic and would never happen. You know, as far as the money being protected, it all sits at a custodian, a third party where there's SIPC insurance and the like. So we don't have any concern at all about the solvency of any of the of either the custodians or the fund companies. And even if that solvency came into question, it wouldn't impact the value of clients' holdings, other than potentially on a very short term for a day or two with pricing issues or something like that. But in any time frame over that, it wouldn't have any impact on clients' portfolios or values.
Yeah, I think people get confused there with all sorts of different types of mutual funds. I mean, in the liquidity of them versus maybe another type of product.
Yeah.
Right. Because you're in a mutual fund, they're basically carrying the underlying securities within the mutual fund. So they're owning those stocks.
Yeah. I mean, I often think of it like a food store, right? Like if you go to Vons and let's say that Vons hypothetically went under, it doesn't take away the value of all the Heinz and Campbell products on the shelves, right? You just pick those products up and move them over to Albertsons, and the mutual fund is really the same thing.
All right. If we go into a recession, will the market fall another 10% or so?
If I knew that, I'd be a rich man.
But I think another thing is that we might already be in a recession.
I would be willing to say that, if this is my opinion, I think we're already in a recession. I don't see any way that with the sudden stop of economic activity, we're not already in a recession. But keep in mind, again, that stocks are forward looking. So there's a lot of bad news priced in. School closures, sporting event cancellations, conference cancellations, an end to most travel. That's all priced. Restaurants, gyms. Yeah, I mean, that's all priced into the markets already. So you need more bad news for the stock market to continue to fall. Not to say that we couldn't get more bad news, but I always think it's important to realize all that bad news we're also worried about is priced in, as well as a lot of fear of the unknown. So the news cycle has to continue to be quite bad for stocks to fall. And I don't think I think most people accept now that we're going to go into a recession, and they're more focused on how long and deep is the recession going to be and what's the recovery going to be like. So I think that that's a more important question for determining where stocks go from here.
I think what you've shown me in the past, Brian, is that when someone actually declares that we're in a recession, we're almost out of it.
Correct.
So it's, I mean, this thing is fluid. This time, it's always different. But if you could time exactly when you were going to go in a recession, I mean, we would build that into our investment policy statement and say we're going to sell 2 days before we hit the recession. But we just don't know when that's going to happen.
Yeah, and I've worked, with a lot of really smart people, and none of them know how to do that. Just because think about, how do you model out? Let's say in a perfect world, you could have somehow predicted the coronavirus, right? I don't know how you do that. And then even if you do, how do you predict all the knock-on effects of people not being able to go to Disneyland, not being able to go to the movies, of Disney pushing the release date of a Marvel movie, which then impacts all their other movie releases and stuff. There's so many individual human choices in there that to actually model that out with precision is really difficult to do. Just as an aside, there's a common rule of thumb that a recession is 2 consecutive quarters of negative gross domestic product growth. That's actually not correct, even though it's often cited in the media. The actual way that you know that there's a recession is the National Bureau of Economic Researchers names a recession, and they're looking at gross domestic product growth or declines, but they're also looking at a host of other economic factors. And Joe, to your point, they basically come out and they backdate it generally, and they say, hey, you know what? It turns out we were in a recession as of X date, and it ended on Y date.
All right. This is an interesting question, and I would like to hear your take on this. How much volatility is due to machine trading, so AI?
Yeah. I don't know, obviously, the precise answer to that. I don't know how you would quantify it, but my guess is a fair amount. But I would lump machine trading into a larger basket of just kind of the world that we live in, where if you think about it, one of the things that's jarring to a lot of people is the fact, not so much that stocks are down 25%, although obviously that's a little bit jarring, but the fact that it happened so quickly. It's happened in a couple of weeks, whereas in the past, maybe it would be 6 months or a year or something like that. And I think that that's just a function of the fact that things happen a lot more quickly, because really what markets are doing is they're pricing in new information as it comes. And that's one of the reasons that a lot of people believe markets are efficient and it's difficult to predict the future. Markets are now pricing in information a lot quicker because of a variety of things, right? The 24-hour news cycle, the connectivity of people, social media, exacerbating trends and stuff like that. And then I think that machine learning or artificial trading is one of those things that just exacerbates the moves, right? Where there's a lot of programmed trading that piles on. And a lot of it is, there are a lot of strategies, without getting overly technical, that have become popular over the last several years around risk parity and stuff like that, and some other strategies that are rules-based that force you to basically buy what's going up and sell what's going down, which isn't a terrible thing in and of itself. But when markets start to fall, what happens is that you're forced to sell more and more, and it becomes a little bit of a snowball effect. I'm sure that that's exacerbating the moves. I don't think that's why stocks are falling, but it may be why they're falling and swinging up and down as much as they are.
All right. Another question is coming in. If I had to retire next month, how would that change the idea of sticking with current positions?
Well, I mean, I would hope that, knowing that you're retiring next month. Now, if it's a sudden change and all of a sudden you find out you're being forced into retirement, I think you might want to evaluate your portfolio and how you're set up. But presumably, if you knew that this was coming, you were set up appropriately with that in mind. And, to be honest, in a perfect world, the market wouldn't fall by a quarter leading immediately up to your retirement. But again, your allocation was set up knowing that that was going on. And that's why you have bonds in the portfolio, because maybe if you're retiring in April, maybe in May, you need money to take a vacation, or, well, I guess you can't take vacations anymore with the coronavirus, but to do whatever it is that you're going to do, you would take that money out of your bond portfolio. That's the reason that you have those high quality assets, is to provide ballast and to provide dry powder in times when you don't want to sell stocks, in order to give those stocks time to come back. I mean, the way I always think about it is, let's say just pick somebody that's half stocks and half bonds and has $1 million, just for a round number. They have $500,000 in bonds, right? If you're spending $50,000 a year from your portfolio, you've got a decade worth of spending power just in your bonds before you even have to worry about stocks. I don't have a crystal ball, but I feel pretty confident in saying that the impact of the coronavirus and the impact of this market sell-off in stocks will have long since passed in the next 10 years.
Yeah, and I think to piggyback on that, every portfolio that is designed for the client is really to take a look at the cash flow needs. That's why we're heavily entrenched, first off, in cash flow in regards to how much income needs to be derived from the overall portfolio. Then we spend a lot of time on taxes to figure out what is the most tax efficient way that you can generate the income from the overall portfolio, encompass your Social Security, pensions, and any other part-time income or things like that. Then from there, we have enough information to construct the overall portfolio. Then we stress test it, if you will, for situations just like this. So our advice, if this is not new information, would probably be stay the course, because the portfolio is designed specifically for your goals. But as Brian said, if it's all of a sudden, you're getting laid off, then you would want to readdress that. Another one.
Sorry, and Joe, actually, that just speaks to why with virtually all of our clients, we recommend having a rainy day fund, is because things happen, right? And so the idea of having some cash on the sidelines is designed to give you a little bit of a cushion. If, let's say, you're running a business or something and your cash flow's down here for a couple months because of something like this, that gives you that cushion so you don't have to touch your longer term funds and you can, weather the storm.
We have a lot of SDG&E employees, Sempra Energy employees, and so we have a few different questions in regards to the energy sector in stocks. Can you give your opinion there?
Yeah, I mean, so obviously energy has gotten hit pretty good. Sempra is, for the most part, a regulated utility, and so a lot of their contracts are locked into place and stuff like that. So I don't think that the short-term impact there is going to be too significant. The energy sector is obviously down a lot. It was interesting because OPEC tried to get together and raise oil prices by cutting production, and then Russia and Saudi Arabia got in an argument and wound up basically opening the floodgates and flooding the market with oil, which caused it to drop even more. The downside is that energy stocks are down by like half this year as a sector, right? So they've fallen pretty significantly. You can see some pretty juicy dividend yields. I think that Occidental Petroleum, as of yesterday, was yielding 30% or something like that, but they'll probably cut their dividends, so that won't stick around. A lot of that bad news, again, though, is priced in. So you need to go in there and look at one of the screens we use on a lot of our funds is we look at value-oriented companies and but we also look at profitability at companies that are generating more cash flow than their peers. And that's for situations like this, because when the key price of your product gets cut by half, like oil has, there are companies that won't survive and that won't make it. But if you look at companies that are more profitable, they're usually in a better financial position and better position to weather this. The other thing with energy companies is that when you look at declining oil prices, that's another tailwind for the economy. And talking again about why the economy might pick up is having lower oil prices, although it's going to hurt the energy companies of the world, is actually effectively a tax cut for the U.S. consumer. And so as people pay less at the pump, that gives them more spending power and can help cushion any recession that we might go into.
Will Pure be able to operate as normal if there's a full-blown mandatory quarantine?
Yeah, and so we have a disaster recovery program just for instances just like this. And for those of you that haven't seen it, we did send out an email on this yesterday. So if you haven't gotten it, just let us know and we'll resend it. But yeah, we have a disaster recovery plan in place. We last tested it in December with all of the department heads. And the idea is that we want to be, as long as financial markets are open, we want to be fully functioning, trading, able to provide clients with trade execution, distributions, or investments as they need it, as well as financial planning advice and guidance. And so what we've started to do is separate some of our teams. So we've had some of our traders working remotely just to make sure that there's no instance where the virus passes through the whole department. We've done the same thing with client services and operations and with our planning department to make sure that as long as America is functioning, as long as the stock market is open, as long as the office buildings are open, we'll be here fully functioning, ready to deliver financial planning advice and trade execution to clients and to serve all their needs.
Another one, it seems like we're in uncharted territory right now. Wouldn't this call for a different approach to managing money?
I don't think so. It's a good question. I think it's a really valid question. But to me, I don't know that this is uncharted territory. Again, we've had two 50% declines in stocks in the last 15, 20 years. We're not down that much yet, but this is the third bear market of the 21st century. Bear markets happen pretty regularly. There's always a different reason why, right? But I mean, you could argue that a lot of them have been worse. We've had bear markets due to wars. We've had bear markets due to famine, upheaval, emerging market collapses. And I would argue if we're truly looking for a time that things were different, I would say that in 2008, 2009, that was, again, a time where the financial system really was on the brink of collapse. I haven't seen anything yet that has me convinced that this time is different or that the financial system is truly in peril or the financial markets won't collapse. I feel 100% confident in saying that although this is a painful instance, both on a personal level for a lot of people and also with the financial markets, I don't have a shred of doubt that we're going to come out of this it's not going to be a terribly long-lived thing. I feel like by this time next year, certainly, we'll be past the coronavirus. I think that financial markets will be just fine. And I don't see any reason to change our approach. That's not to say that we don't evaluate what's going on and look at it. We're always looking at ways to change the portfolio. We've considered making some changes, but when we consider making changes, it's based on longer run trends that we see happening and developing in the financial markets. And again, I just don't see this as being something that's going to permanently impact financial markets or imperil the financial system in any way.
At what percentage point portfolio loss should we opt into taking Social Security? I'm 63.
Wow, that's a really good question. I think then, Joe, this goes back to what you were talking about. It goes back to the cash flows, right? I mean, it goes back to running through their financial plan, running through the cash flows and seeing what kind of the position they're in, right? And so what I would say is reach out to your advisor and have them go through it again and see where you're at. How do the cash flows look with a reduced portfolio value? And does it make sense to take Social Security, right? And if you determine that it does, I mean, know that you could always take it and then freeze it at some point if you wanted to, if the portfolio recovered. But I wouldn't make the decision to take Social Security lightly if that's not what you had previously planned to do. But I think running through it again and seeing what things look like makes sense. And that's something that we do all the time in basically every meeting with every client.
Well, I think too is some people will be like, all right, well, maybe I just turn on the income versus touching the portfolio.
Yeah.
What other options do people have?
Well, I mean, they could cut spending, but a lot of people don't want to do that, right? But if they have other income sources, they could turn them on. They could cut spending. They could draw down some of the bonds or some of their rainy day fund, temporarily draw that back. Again, if they take the Social Security, they could turn it on temporarily and then turn it off. So, but it depends on each person's individual options.
Looks like in general, in the good times, peer has underperformed. Is that protecting us now? And how will we aggressively recoup our current losses?
Yeah, that's a really good question. Yeah, I mean, relative to the broader market portfolio, most of our clients, not all of you, but most of you have a diversified portfolio of stocks and bonds. So for the most part, that kind of portfolio is going to underperform just the S&P 500 in a bull market and then hopefully cushion some on the downside. And so what we've seen so far this year is that, the bond market's up 2 or 3% for the year, whereas stocks are down quite a bit. And in my experience, and I've been doing this a while, is that everybody loves diversification at times like this. They don't like it so much when stocks are in a rampant bull market, but this is why we have diversification in the portfolios. And yeah, I feel pretty good about how the portfolios are positioned at the moment, because again, I think that some of the international securities are well positioned for going forward. I think that if the economy snaps back, our tilt towards smaller companies will also do well, because in the early stages of an economic expansion, and again, if we're in a recession now, then at some point we'll come out and we'll begin to go back into an expansion. In the early stages of that, both smaller companies and value companies tend to do pretty well. So I think that would position us appropriately. And then I think that the international stocks and the emerging markets are both relatively attractive from a valuation perspective. And then also, and I don't have a crystal ball as far as currency movements, but if you look at what's going on with the U.S. lowering interest rates as much as it has, all else being equal, that's dollar negative. And one of the things that's hurt international security returns for U.S. investors over the past several years is the fact that the dollar has been very strong. And so, one of the reasons for that is just that U.S. rates have been so much higher than international rates. If those start to equalize and the dollar weakens a little, that should be good for U.S. investors in international securities. So yeah, I think that we're well positioned to go forward.
I can understand the frustration too, is that, all right, I'm globally diversified. U.S. companies, large growth specifically, has done very, very well.
Yep.
So I didn't capture the full upside of the market. And when people think of the market, they could be looking at the Dow or the S&P 500,
Yep.
which is only, two markets in a land of, I guess, thousands.
Yep.
And then you get a correlation of one in a matter of like a month, right?
Yeah.
Where you want negatively correlated asset classes as much as you can. So when one zigs, the other zags.
Yep.
But in a time of pandemic, it seemed like all asset classes are falling.
Yep.
And so I'm getting the full brunt of the downside. So did diversification really help me out this time?
Well, I would say on the stock side, not that much, no. And you're right. In general, in a market panic, in the short run, there's an old saying that correlations all go to one in a sell-off, right? And so, yeah, so you see whether it's small companies, large companies, value growth, U.S. international, they all kind of fall. It's in the recovery that you start to see divergence. But what hasn't fallen commensurately is, again, those high-quality assets, the bonds. And, for the last several years, high yield bonds and the like have had a pretty good run, and it would have been really easy for us to move out of the higher quality bonds and move into more high yield type bonds just to generate a little bit of extra income in the portfolios. And we kept disciplined and didn't do that for a reason, or for two reasons. One is that we didn't think that valuations in high yield were that attractive. We thought that they were a little bit expensive. The other is because high yield bonds tend to be more closely correlated with stocks. And we've seen that in this cycle where our bonds have held up pretty well, and even in a lot of cases either provided positive returns or basically stayed flat, whereas high yield bonds have done very poorly and stuff. So we have gotten that diversification from the bond portion of the portfolio.
A few questions I guess that I have for all of you that are on the call today. Do you like this type of communication? This is basically, the first time we've tried to do a live streaming type communication with our clients where we can interact with a bunch of you at the same time. So we want to do more of this. We'll want to do a lot more type of education and classes via streaming, just because my class load is lightened up quite a bit. And same with Brian's, since we can't really get into the classroom. So I know a lot of you have been to our classes and educational events. And so this was a trial. I want to thank Alyssa and Annie, who was working diligently within our communication, media, marketing departments to give us the technology to do this stuff. So with our meetings moving forward, at least over the next couple of weeks, we would like to do Zoom meetings just for the health of our clients. And I like to say in our employees, but our average age, most of the employees are fairly young, but they might have something that they're not affected by. And then, that's the last thing that we would want to do. So bear with us over the next couple of weeks as we look at the CDC, and we'll take their guidelines on what we should be doing in regards to interacting again, like we're used to. I know this is uncharted territory for all of us. And so we really, truly appreciate your confidence and your trust that you've put with us. And I know a lot of you for the last several years. So we will continue to do more information sessions like this. Stay tuned. We'll try to get as much information out to you as possible. We don't want to flood your email box, but it looks like we're getting some really good responses on this. So look out in the future for a lot more of these. So let's see, I think we got, now just a few nice comments. So thank you, Nancy. Nancy's been with us forever. So thank you for the nice words there.
And Joe, before we wrap up, what I would say, and I'm going to borrow this from Jonathan Clements, who you and Al had on the radio show once, so I'll give him the credit for this, but I think this is a great kind of point that he made, is that if you think about people's quality of life over the last 100 years, it's improved quite a bit. And when you look at stocks over the last 100 years, they've gone up dramatically. And so that's because corporate profits have improved, right? People's quality of life improves because a company makes a good or service that people like, and that flows through to corporate profits. And so if you're optimistic, forget what's happening today, what's happening next week. If you're optimistic on the progress of humanity for the next 20, 30, 40 years, you almost need to be optimistic about stocks, particularly when they're selling off like this and you can buy them a little bit cheaper, because some company is going to make a good or service that's going to cure a disease, whether it's this one or other diseases, that's going to improve communications, that's going to improve people's quality of life, and they're going to make money doing it. That doesn't tell you what company or what sector is going to do the best, but it does tell you that there's a significant tailwind helping investors across time. So as long as you're optimistic about the future, again, we're in a blip, but if you're optimistic about the longer term future, you should be optimistic about stocks. And I always look back to October 1962, and I always come back to that. Is in October 1962, we can talk about uncertainty and troubled times now, but that was the Cuban Missile Crisis, where children were hiding underneath their desks because the world was at the brink of nuclear war. And it came out that Russian generals had orders to launch nuclear weapons at the U.S. if U.S. troops landed on Cuban soil. And so the world was that close to nuclear Armageddon. At the time, the Dow was at 400, right? Since then, JFK got shot. We had Vietnam. We had Nixon impeached and stagflation. We had Reagan got shot. We had Clinton got impeached. We had the dot-com bust. We had the financial crisis, which was the worst collapse since the Great Depression. We have whatever's going on now, and yet the Dow's north of 20,000 despite all of that turmoil that we've had. And so if you just look at the history, markets go up over time because people progress over time and companies do great things over time. And so I don't want to sound like a cheerleader because we are in a difficult environment, but I don't see any way that coming out the other side of this, that the economy and markets don't return to doing really well. And in the meantime, that's why we diversify, is that we have those assets that are holding in there, that are supporting the portfolio values and being used to provide income for clients that need it in the meantime.
Okay. If you have questions, please contact your advisor. You can always contact Brian or myself as well if you have other questions. Go to yourmoneyyourwealth.com. We release podcasts out every week. Al and I do. We're going to start season 6, our TV show here. I think in the coming weeks, we got a ton of content to go through. So we'll be putting out the TV show, the podcast, the radio show, and then a lot more live streaming education courses for all of you. So thanks again. And again, be safe. I guess a lot of us are going to be working from home and hanging out. Try to stay busy. Again, if you have any questions, feel free to reach out. Thanks again for your trust.